Hello everybody, Tortoise Investing here, coming at you today with an article from 247wallstreet.com. Morgan Stanley has 6 blue chip high dividend stocks to buy in the month of June. So we're going to go through them using Qualtrim Insights. This is what I use to analyze stocks. We're going to break down all these picks, what I think about them. Now, if you're new, please hit that subscribe button for me. I'd greatly appreciate it. Drop a like and comment down below if you own any of these. Those things help the videos and the channel out tremendously, and I greatly appreciate it. Go check out some of my recent uploads if you haven't as well and you have the time. None of this financial advice, always doing research for investing. Now, let's go ahead and take a look at them. There will be timestamps in the description of the video for all the individual stocks, so if you want to skip to a specific one, you're able to do so. Next, first up, we have BP. Just free cash flow yield 13.11%, dividend yield of 4.64%, and a payout ratio of 8.98%, so very low. This is an energy company. It deals with oil, very all over the place. If you look here over the last 10 years, we got a lot of ups, we got a lot of downs, kind of all over the place. Me personally, I think the time to have bought into oil was back here. And back here during COVID. Because I don't know if it was here or here. Oil went negative for a little bit. It was absolute chaos. Everyone thought the end of the world was upon us, and it eventually bounced right back. But on those big downturns, when oil is like incredibly cheap, if there's ever another crash in a $20-$30 per barrel range, might take a peek at some oil companies. For me though, it's personally not what I look into, but it might be what you like. Let's take a look here at the revenue. As you see, it is kind of going down over time. Free cash flow, this is trending in the right direction. 23.55% over the last 5 years. EPS growth, and it's very kind of everywhere. It's the reason I think I like predictability with companies. I like things that are up and to the right, or the share count is down and to the left. Down and to the right, not down to the left. That'd be the other way. Anyways, let's take a look here at the dividend. They've cut it a couple of times. Again, this is also kind of all over the place as well. Been growing it here recently, though, at a rate of over 10%, which is nice. Share count looks like it is going down. We'll take a look at the quarterly here for the share count. Oh yeah, let's take a look over the last 5 years, and we've got a nice downtrend. A nice aggressive downtrend. I like that. I like that a lot. Over the last 2 years, buying back shares at a rate of 6.24%. I like that a lot. Let's see what the debt updated. Debt's $48.35 billion. Cash is $32 billion. I don't think that's that big of an issue. And return on capital employed, again, it's kind of, you got your up years, you got your down years. EPS growth, on average, looks like it's going to be going from 467 to 523 over next year. And revenue is going to be down a little bit. So I'm guessing they see the price of oil either staying around where it is or decreasing over time. Alright, next up we got BTI, British American Tobacco. Just free cash flow yield 19.8%, dividend yield of 9.58%, payout ratio negative 28%. What's going on? Well, they had a negative EPS year. That's what's going on there. Let's take a look here over the last 10 years, down 48%. This is a sin stock. You buy this thing for its dividend. Revenue's been increasing over to 5.98% over the last 10 years, which is nice. Free cash flow, 10.53% over the last 10 years, again, which is nice, very nice. These sin stocks, British American Tobacco, Philip Morris, we'll take a look at later on, and Altria You want to look at the free cash flow. The free cash flow more than just the payout ratio of these. They did have that negative EPS year, but besides the negative there, it looks like it had been trending in the right direction and growing pretty consistently year over year, which, it's not bad. Take a look at the updated debt. We got 44.47 billion. Cash is 3.78 billion. EBITDA is 12.67 billion. So a little bit heavy on the debt side. My general rule of thumb is I don't like companies that have more than 3 times their EBITDA in debt. If something major was to happen, financial troubles was to occur, it would hit them a little bit harder than it would a company that's got a bit of a better balance sheet. Now the dividend, pretty flat since 2018. It's went up a little, down a little, just a couple cents here and there. And the share count, this is one I want to take a look at as well. Take a look here over the last 5 years, and we are trending slowly in the right direction. Nothing really too big to write home about, but that share count is going down over time. I do like this return on capital employed trend up and to the right. I like that. I like that a lot. That's very nice. It looks like they had that year last year, but yeah, on the quarterly, it's not looking too bad. EPS growth, 368 to 386 over the next year, and revenue 4356 to 4497. So they're looking at a small increase, a little bit of a bump in their revenue. I know that they've got a lot of vapes, smokeless options, stuff like that. BTI does a pretty decent job of having a diversified portfolio when it comes to their products. But yeah, I mean, you're looking for yield, might be something that you want to look into. BTI. Next up, we got gaming and leisure properties. Adjusted free cash flow yield of 7.92%. Dividend yield of 6.77%. Payout ratio is high, but this is a REIT, so we don't care about that. You care about funds from operation. You want to see that free cash flow growing. Alright, over the last 10 years, up 33.91%. They had a massive drop right here. Looks like it dipped right down there to the 15 mark at one point. That would definitely been the time to jump in with it. But I know a lot of REITs are down over the last year because of higher rates for longer. Higher rates for longer. We're going to cut 7 times this year. JK, now it's 5. JK, now it's 3. JK, are we going to cut? So a lot of your interest heavy influenced companies, stocks, holdings have been beaten up. So I have no idea when they're going to cut. I don't know. I have no idea. Revenue over the last 10 years, 19.52%, which is pretty nice. Here recently, mid to upper single digit growth from revenue. Free cash flow, 8.15% over the last 5 years. Pretty nice. Like to see that. Debt, they have 6.33 billion. Their EBITDA is 1.36 billion. Again, it's a REIT. REITs usually carry, usually carry a lot of debt. Nothing outside of the ordinary there. The dividend looks kind of funny. Let's look at it on a 5-year chart. Slowly going up. Again, nothing too fancy. We got a dip here, dip here, dip here. I don't know if this is a special dividend or not. But I mean, it's pretty consistent. When they did cut it here and here and here, they didn't keep it there. They bumped it right back up. So yeah, I don't know. If you're looking for REITs, might be something to take a peek at. Revenue looks like it's going to be kind of flat-ish. They're seeing a tiny bit of growth out of revenue over the next year. Next up, we got Lazard, L-A-Z. I have no idea what this company is. Just free cash flow yield of 1.16%. What in the world is going on there? Stock-based comp is what's going on there. They gave out more stock-based comp last year than they did free cash flow. I don't like that at all. I do not like that one bit. No. Okay, we'll still take a look at it. This is a financial services company. Let's take a look at the revenue. Revenue is pretty flat for a while. No big Looks like they were trending in the right direction. They kind of tapered off, so I'm not sure what's going on there. Again, I don't know a lot of these companies. I'm just looking at the numbers. Free cash flow. This is just a mess. This is all over the place. It's up, down, all around. No consistency. EPS, same way. Up, down, all around. Let's take a look at the quarterly. Stay updated debt. Debt's 1.69 billion. They had right at $1 billion in cash. And their EBITDA was negative last year. EPS was negative last year as well. Take a look at the dividend. Dividend's been growing at a rate of 5.24% over the last 10 years, but here recently at a rate of 3.14%. Yeah, it was up to 44 cents, then to 50 cents, then down to 47 cents, then back up to 50 cents, and they've kept it there for a bit. Shares outstanding at Dagger. Looks like they're buying those back. Look at that. Let's take a look here over the last 5 years. So this was trending in the right direction, and now it's going back up again. I like this. I hate this. This company seems like a mess. Let me know down below if you know anything else about it, but just from first glance, it seems pretty messy over there on the for old LAZ. Average EPS growth got $2.98 growing to $3.90, so that's pretty rapid for average, and then 2.92 billion growing to 3.19 billion for revenue over the next year. This would be the hardest pass in the world. There's way too much going on. There's too much ups and downs and all arounds. There's no consistency to it. Not my cup of tea. Next up, Fieldmore's, another sin stock here. Just free cash flow yield of 5.54%. Dividend yield of 5.13%. Payout ratio over 100%. But again, look at free cash flow. Free cash flow is what you want to look at. Normally it would be EPS, but for these sin stocks, because they purposely pay out higher dividends, you want to look at the growing free cash flow and make sure that that is increasing. Over the last 10 years, up 15%. It looks like it had some nice dips here. In 2018, hitting the 60s, 2020 hitting the 60s, and here recently I had a dip down in the 80s area. So, again, you buy these for the yield. If this dips down in the 80s, you're probably looking at a dividend yield close to 7%. Revenue's been slowly trending upward. Let's take a look over the last 5 years. Yeah, it's grown from 29.81 billion to 35.17 billion. So it is slowly but surely growing. Free cash flow, positive, but no big increases. It's pretty much where it was back in 2017. Nothing too big here. No big red flags though. No negative free cash flow. That would be a big giant concern. EPS again pretty flat as well. Let's take a look at the debt on the quarterly. We got $44.68 billion in debt, a little bit over $4 billion in cash. Their EBITDA was $14 billion last year, so right there at that like slow down range. Dividend's been increasing at a rate of 3.3% over the last 10 years. It looks like there for a bit they were doing very tiny hikes. I'm talking less than 3% over the last 5 years. Usually whenever I invest in companies, I want something that's going to give me inflation-beating dividend increases. I know that's not the case for everybody. Some people just want that yield and get that snowball going even quicker. But for me personally, I would like to see all of this be above like 3-4%. But yeah, this is how it's setting right now. Shares outstanding, they have not really touched this in a hot minute. Pretty much where it has been. And return on capital employed is decreasing over time, which is not good. You don't want to see that. You want to see this either be flat or slowly growing. EPS on average, $6.30 growing to $6.62 over next year. So that's a nice little bit of growth. Revenue, $36.94 billion growing to $39.23 billion. That's Very nice. I like that a lot. If they can grow that to 39 billion, that would put them right up here on the chart. That'd be good. If they could keep that going, that'd be great for them. Yeah, Philip Morris, again, if you like what you see, take a look at it yourself. And lastly, we got Ternium Ternium, probably saying it wrong. Just free cash yield 9.19%. Again, this is a company I have no idea what it is. We're going in blind here. Dividend yield 7.64%. Payout ratio 100%. What are we dealing with? Basic materials. Okay. Take a look over the last 10 years, up 54.77%. Oh, looks like they had a massive 2020 dip, and back in 2022 as well. Setting at 43.18. Revenues grown at a rate of 8.35% over the last 10 years. This is very consistent. Very, very up and to the right. I like that. Free cash flow is not that way. I don't like that. It's growing, but again, it's kind of skipping around a little bit on me. Excuse me. EPS, same way. This is just, I don't know what's going on here. This is crazy. This is just nuts all over the place. Take a look at quarterly for updated monies. We got 4.08 billion cash on hand, 1.18 billion in debt. So that's not an issue. They can pay that off whenever they would want. Looks like quarter over quarter, things are trending in the right direction with their revenue, so that's nice. The dividend is confusing. It pays every twice a year, looks like. So yeah, we're growing from 80 cents and $1.80 to 90 cents and $1.80, $1.10 to $2.20. So yeah, that's how they have theirs structured out. It looks a little confusing, but it is growing. It is trending in the right direction. Let's take a look at shares outstanding. Flat as pancake, pretty much. Not too much going on. It slowly decreased there for a second. Back in 2010. This hasn't done anything since 2011. Alrighty. And the return on capital employed is, again, it's kind of a little bit everywhere. EPS pretty much flat from this year to next year, and revenue going to be slight growth, 19.15 billion to 19.24 billion. Otherwise, pretty flat there as well. So that is 6 stocks, 6 blue chip high yield dividend stocks to buy in June that Morgan Stanley has put out, and we did a quick little breakdown of them all here. I hope you enjoyed that. Make sure to hit that like and subscribe button for more, and until next time, take care. See you.